Good afternoon, everybody. We'll just give it another 20 or 5 seconds or so just to make sure everyone can call in okay, then we'll get cracking. Good afternoon, everybody. My name is Richard Hafford, and this webinar has been hosted from Nasdaq's office in London. Today's speaker is Gary Delany from the Options Industry Council, OIC, and Gary has joined me today to talk about the basics of options trading. I'd also like to highlight that in 2 weeks' time, Gary will host a more advanced session. And without further ado, I'd like to hand over to Gary, and Gary, warm welcome to Nasdaq.
Thank you very much. Yeah, thanks for the intro, Richard. It's very nice to be here. Thank you for inviting me to present to your Nasdaq audience today. It's funny, Richard and I are sitting here in a conference room in their offices in the City of London. I know some of you will perhaps be on the bus going home from work. You know, you may still be at work, just catching up with this from your desk. But wherever you are, thank you for joining us. What I'm going to talk about this afternoon is some of the things which I feel the starting investor in options should know. All right? So it will not cover everything from soup to nuts, but I hope I give you a taster and a good place to start. My name is Gary Delany. I work for the Options Industry Council. I worked for them for about 10 years, and before that I worked in the exchange area in a variety of options-related capacities. The Options Industry Council, for those of you who are not familiar with it, is an educational utility. It's funded by the US Equity Option Clearinghouse, OCC, and it's funded and managed by OCC. But its particular aim, its target, its focus is to promote the responsible use of options. Now, although that is related to the US equity option industry, the comments I'm making today about options are generic, so it doesn't matter. You don't have to trade US equity options to make what I say valid. If you are trading options in any shape or form, I think you will find a relevance. I'm afraid that in the wonderful world that we live in, no presentation is complete without a disclosure document. Next slide. There we are. So options involve risk. They're not suitable for everyone. If you're going to trade US equity options, you need to read the disclosure document, which you can see outlined there. In order to simplify things, all the examples that I use today in the webinar exclude things like commissions, fees, margin interest. And any strategies that I mention, I'm not recommending a strategy. This is for educational or illustrative purposes. So what does OIC offer? We offer free, unbiased and professional options education. If you go to our website, which is optionseducation.org, you'll see everything that we offer. We make no charge for anything. You can get podcast videos, webinars on there, as well as some useful tools and publications, which I'll talk about towards the end of this. There's also an investor services desk featuring real people who will talk to you or respond to you. I think there's a chat bot as well. So that is another useful resource. I know Nasdaq has its own Nasdaq Academy, which you should also be looking at as a resource for your knowledge. But OIC also offers one. I'm not going to bore you to death with volume slides, but this is the US equity option volume since the year 2000. And you can see that last year we cleared about 4.5 billion contracts. Nasdaq is one of our major participants. This shows, I think, this graph shows how much the options business in the US has grown, and typically about 10% of this order flow comes from Europe. So what we're going to cover today, we're going to talk about why should you trade options at all. You know, if there's no point in trading options, you shouldn't be. So I think that's a good basic thing to look at. We're going to be looking at an option, a definition of an option, what is an option. We're going to be going on to look at the 4 basic strategies. That's buy a call, buy a put, sell a call, sell a put. And I do go on about those a bit, but I think it's very important that you understand what can go wrong and what can go right. So I think that's very important. Then we'll be going on to the essential mechanics of options trading, that is the underlying, expiration, exercise style, and exercising an option, and what terms such as in, out, and at the money mean. Then I'll be talking about option premium calculation, just to give you a flavor of what goes into an options value, and then making some suggestions for further reading and things that you would find useful. So that's the layout of the session. Let's start with the basic one. Why trade options? I think there are 5 basic reasons why you should trade options, and they're listed here. For the buyer, so if I buy a call or buy a put, I can participate in the market with limited risk. The fee that I've paid to buy the call or buy the put, which we call the premium, is the most that you can lose. It might still all be your investment money, but that's your stake, if you like, when you start. The premium is the most that the buyer of a call or a put can lose. The second reason, which is related partly to the first, is you can participate in the market with a limited cash outlay. Now, if I was buying the underlying stock, I'd have to, shell out entirely for it, or do it on margin, perhaps. Whereas if I'm buying a call or a put, my expense is going to be much less, so a limited cash outlay. Of course, there is the consideration that options don't go on. They've got a limited lifespan, unlike the underlying security. So, because it's a limited lifespan, you have to bear that in mind. And I think we will see in some examples subsequent to this slide, you'll see how that works. The other thing you can do with options is you can create unique anticipated payoffs. Now, by that I mean that you can combine varieties of options in different ways. You can put them together with different underlyings, and you can say, well, if the market moves to here, this is going to be the outcome, or if it goes down here, this is going to be the outcome. We think this sort of move is likely, so we've positioned ourselves, to maximize that. So that's what I mean by creating anticipated payoffs, and we'll cover that in more detail on the next webinar that we do, and I think it's the 12th of February, isn't it? Yeah, thanks, Richard. And then finally, you can use options for the 2, what I would call traditional reasons. You can use options to protect profits. Classically, if you're holding a stock and you're fearing it's going to go down, you can buy a put, you buy an at the money put, an out of the money put to make it cheaper. And finally, the speculative reason for trading options, that is to harness leverage. So these are the reasons why you should consider trading options, and I think it's good just for each individual investor to run through those. So if we didn't have options, you would have more limited choices as an investor, and I think the positions that you could take would be less interesting. I mean, essentially, if there weren't options, you would have the choice of two linear outcomes. You could either be long stock or short stock. So you can see there's a straight blue line there. If you buy a stock and it goes up, you're making money. If you buy a stock and it goes down, you're losing money. And the inverse with if you've got a short stock position. But if you add an option to the equation, you've got many more choices. I think some of our audience today will be from Scandinavia, so you will know what I mean by a hockey stick. I've given the same presentation in London, and you say hockey stick, and people look at you blankly. But if you look at these top ones here, long call, long put, short put, which I'll go into with in more detail in a moment, you can see they've got a classic hockey stick shape, but also it's not a straight line. You know, you look at a long straddle at the end of the top row. You know, that's not a straight line. Same deal with strangles, collars, whatever you want. Now, obviously, I haven't got time today to go into all of these, but all of these strategies, if you go on optionseducation.org and just type in the strategy, it will tell you the pros and the cons, the downside, the construction. So, you know, do use the online resources as well, please. So what is an option? Most of us know pretty much what an option is, but there's no harm restating it so that we're all clear. An option is a contract which gives the buyer of the option the right but not the obligation to buy, in the case of a call option, or sell, in the case of a put option, an underlying asset. So let's just look at the important phrases there. The buyer is getting a right. He's buying a right but not an obligation. All right? To buy, in the case of a call option, so I'm calling something to me, or sell in the case of a put option, you know, I'm putting something away from me. Options have a specified price, that is the strike price or the exercise price. And as discussed before, options have a finite time limit, and that is the expiration date. And so that is our classic definition. The four basic option strategies I've put here. If we go through them one by one, if I'm long a call, if I have bought a call, I have bought the right to buy the underlying security at the strike price any time before expiration. And as the buyer of the option, I'm paying a premium to the seller. Same thing applies to the buyer of the put option, but in that case, I'm acquiring the right to sell. All right, so I'm in the driving seat. I've paid the premium to the seller for this, so I've bought a privilege. I've bought a right, and that's true for buying a call and buying a put. Flip side, if I have sold a call, all right, then I'm entering into an obligation to sell the underlying security to the person who's bought the call. It's up to him whether he calls that, whether he exercises his right or not. It's not up to me. I'm receiving the premium as the seller of the option, and accordingly, I'm taking on the obligation. And the same thing is true of a seller of a put. Okay, the rights of the option buyer, as I've said, but I will say again, so I think it's extremely important. In return for paying the premium, the option buyer has the right to buy in the case of a call or sell in the case of a put, specified number of shares of underlying. And it's worth noting that not all options have the same size. US equity options are typically on 100 shares of underlying. I think most Nasdaq stocks are as well, 100 shares of underlying. There are exceptions. And that is done at the strike price or exercise price per share if the option is exercised. Now, to take a profit, you do not have to exercise an option. There may be cases when you wish to exercise an option, when you wish to hold the underlying security, That might be, you know, for dividend reasons or tax reasons, but typically, unless you want that, it may be easy or easier to just sell the contract in the market and take the profit. That way, that avoids all the administration of actually holding the share. And of course, only option buyers can exercise an option contract. I said I would come back to these classic hockey sticks. So here we have the long call and the long put. From the point of view of the long call buyer, here's the premium that he or she has paid. Here's the break even, which is the strike price plus the premium paid. And beyond that, this area here, that's his profit. And with the put, obviously the put buyer is hoping for the market to fall. That's the most that he can lose. And if it continues above or below the break-even point, happy days for him. He or she is happy. The obligations of the option seller, in return for receiving the premium, the option seller has the obligation to sell in the case of a call or buy in the case of a put. Again, specified number of shares at the exercise price agreed, if he or she is exercised upon. Yeah, and that's what it looks like graphically. In the case of the short call, this is the premium that the seller is receiving. That's the most that he can make. If the market rallies, he's going to be making an increasing loss. And the same thing with the put. Here is the maximum income that he will receive, and then if the market falls away, then he's going to be making a loss. And if for any reason an option investor finds himself or herself in a position that he wants to get out of, then it's easy to reverse the position. If I'm long a call, I sell the call. If I'm short a put, I buy a put. And I square myself out that way. And that's something which has happened over the last, I suppose, 30, 40 years. If you speak to the old timers in the business, they will say, well, the options used to be hold and hope. You just buy them and hope that the option would go your way. Well, often that didn't work out so well. And these days you can trade in and out as you wish. You know, that's the whole point of a traded instrument. I want to talk about leverage, and I gave that as the classic example of a speculative play. So let's just, I've got an assumed share here, and I bought a 60 strike call for $3. The unit of trade is 100 shares, so multiply that by the $3 to get my total cost, which is 300. The maximum I can lose is that 300. The break-even price there is 63. So if we look at the outcomes for various price levels on this graph here, we can say that if the stock is at 63 at expiration, and the 60 call is going to be worth $3, which is what it costs, so there's your break-even, 63. Alternatively, if the price declines, a 60 call isn't going to be much use if the stock's trading at 55, because you can buy it in the market at 55. So the premium that you've paid, the $3, you know, that's just a sunk cost in this example, and so you've got a loss of $3 if it goes down to 55. But of course, if it goes up to 70, I'm going to be making $10 on the 60 call, less my $3 premium that I've paid, so I've got a profit per share of $7. Now, if we look on the next slide, you can see in those first two columns there the profit or loss that we're making on the option, and if you look at the third column, the percentage profit or loss. Remember, we've got a $3 stake. If it goes up to 70, then I'm going to be making 230% plus on that. If it goes up to 65, I'm going to be making 67%. But of course, if it doesn't move or goes down, then I've got a loss of that premium that I've paid. Compare that with the two final columns there, buying a stock. If I buy the stock at 60 and it goes up to 70, I'm making $10, which is a percentage of my stake, because I have to buy the shares outright, is about 17%. Or alternatively, if the stock goes down by $10 to $50, then I'm going to be losing 17%. But of course, as I've noted before, a stock goes on, whereas an option has a finite life. So I think the takeaway from this slide is that if you are positioned correctly and you read the market correctly, the leverage is good for an option play. If you are not reading it correctly, the cost may be high, but do remember, of course, if you feel something's going the wrong way, you can get out of the position. I want to move on now to some of the essential mechanics, the nuts and bolts that all options have. All options have defined terms. Firstly, there's the underlying security, which can be a stock, an exchange-traded fund, an index, and it's very important you understand what you're trading. Some of the products out there in a variety of markets can be quite fancy, quite complicated. A lot of them aren't, but always be sure you know what you're buying or selling. The underlying number of shares, as I mentioned before, is contract specific, so you need to check the fine print, see how many shares it's for. Remember that all options expire, and you can trade a variety of expiration dates, you know, right out to probably beyond a year. The weekly options, for instance, in the US at the moment are quite popular, but all options expire. And as I keep saying, like a broken record, positions can be traded out of prior to expiration or run until expiration. Exercise. Exercise is when the owner of a call or a put uses his right to buy in the case of a call or sell in the case of a put the underlying security. As mentioned before, to take your profit, you don't need to exercise an option. You can just sell it in the market. But if you need the stocks for some particular reason, you know, then you submit an exercise notice and then you go through the procedure. Style. Now, style is something that confuses a lot of people. We have American style options, and we also have European style options. Now, those descriptors have got nothing to do with location. American style options can be exercised at any time. So I look at it as, let's say you go to an American restaurant and there's an enormous salad bar. You know, there's lots of choices there, so you can have whatever you want. And I look at American style options in the same light. That's just me. So they can be exercised at any time. The contrasting style to that, which is not listed here, is the European style option, which can only be exercised just prior to expiration. So those are the main differences. Most of the options traded on US exchanges are American style. And Richard, how is it with your options in Europe?
With the European options, and certainly with the Nasdaq options we have, all the single stocks are American style options, whereas the index options are European style.
Yeah, so you need to check what style the option that you've selected is. I want to talk now about in the money, at the money, and out of the money options. Here we have a theoretical stock price of 50, which for the calls at 50, they are okay. Forget that. They are at the money, Whereas if you look at, if I'm holding a 40 call and the market is trading at 50, that's going to be in the money by $10. The 45 calls are going to be in the money by $5. So the at the money, as I said, are the 50s. And then if I've got the right to buy at 55, I'm holding the 55 calls, they're going to be out of the money. And this will be reflected in the price that they are trading at. We have similar deal the other way around for puts. A put is in the money if the stock price is below the strike price. So in this case, the stock is trading at 50, but I can trade my 60 put. It enables me to sell my stock at 60, so it's $10 better than in the market. So they're in the money, as are the 55s. The 50s are at the money, and then the 40s and the 45s are out of the money. So I mean that's pretty obvious, but there's no harm stating it and being aware of it. This does have an impact on the options price. I want to mention the role of the clearinghouse just very briefly. The clearinghouse stands between parties to a trade, stepping in to guarantee performance on a transaction. If either party defaults, the option seller will lodge margin with the clearinghouse. The option buyer will pass the premium to the clearinghouse. And it's just a very important building block of a marketplace to make sure that contracts are honored. If we didn't have these, I don't think we would see the same level of confidence from users in futures markets or option markets. Option premium calculation. I just want to say a few things about that because it's very important. If you look at the determinants of an options price, which we call the premium, these 6 factors go into the equation. The price of the underlying, the exercise price of the option. So we've just looked at in, at, and out of the money. You get the idea for that. There's the time to expiration. That will influence the value of the option. And remember that time decay is not linear. It doesn't go in a straight line. It decays more steeply the closer you get to expiration. So I suppose if you want to avoid the effect of time decay, you should trade something further out, looking to liquidate it before it gets to expiration. But again, it depends what position you've got and what you're trying to do. Interest rates are important. Interest rates are obviously near zero at the moment, but at the days when the US interest rates and European interest rates were higher, that was a major consideration. The dividend, the stock yields is an important ingredient. And finally, volatility. Now, I'm not going to go into volatility at enormous length. I was saying to Richard before the webinar began that we could do, I think, a series of webinars on volatility. But volatility is the interesting one because you can look back and see how volatile a share has been, but that's not necessarily a forecast as to what it's going to do going forward. It might be, but it might not be. And remember that volatility is the deviation, from the mean. It's the zig and the zag. It's not the trend. So volatility is one which can change at short notice, and with it the value of your positions. Intrinsic value is a phrase that I want to talk about just a little bit. And if we look at the top two there, the price of the underlying and the exercise price of the option, well, the relationship between that really dictates the intrinsic value. And the intrinsic value is what your option would be worth if you exercised it today. All right. So in the money calls and puts, of course, because they have value, if you exercise them today, have intrinsic value, but they may also have time value. Now, time value is the chance of the option becoming worth more, or indeed less, I suppose. But it's a measure of the chance that it will go become more valuable. All right, so at the money and out of the money calls and puts have no intrinsic value. You know, if you exercise them, they wouldn't be worth anything, and they're all time value. So they're all talking about, you know, potential, what could happen. To make that a little clearer, here's a little example. We've got my old favorite XYZ trading at $53 a share. The 50 call is trading at $4.20. So it's in the money by $3. So if you take $3 away from the $4.20, you've got the time value of $1.20. So time value and time decay, as I have said, time value is any premium in excess of intrinsic value and reflects, I suppose, the chance that the option may move into the money. Time decay is the decrease in option value as expiration approaches. As I've said, it's not linear, it steepens towards maturity, and at expiration, the option is only going to be worth its intrinsic value as there's no time value left. Volatility, as I mentioned, that measures the fluctuation in the price of the underlying, either up or down. Historical volatility can be measured, but it is historical and not a prediction. Will history repeat itself? Well, I don't know. As I mentioned when I started the webinar, OIC offers a lot of tools, and if you go to optionseducation.org, you look under menu in the top left, and then select item 10.4 options calculator, you can build your own option. There are various variables which you have to put in, but I find it's a great tool for having a play with. So if you put volatility in at 5%, you know, you get one value, but if you raise that to 35%, it's quite interesting to see the impact on the value of the option. Ditto with time, exercise price. You can actually play around quite a lot. So it's educational, but it's also fun. And then finally, I'm just going to direct you to a couple of things on the website which I think are worth looking at. If you search the OIC website by Investor's Guide to Trading Options, there's a PDF of the Lightbulb Press publication that we have there. It's something you could download to your phones and, you know, read on the bus in the morning or in the evening as well. You know, we're very versatile. And also there is the Option Strategies quick guide, which you can download as a PDF and gives you an outline of the various basic strategies. You can also go onto the website and just search by a particular strategy, or indeed many other things, and it will give you a definition, you know, help you to understand how a strategy is built. But as we have mentioned to you earlier, on the 12th of February, we'll be doing a more advanced webinar, and we will be covering some of these themes there. So that really is pretty much me done. You can contact me there, gdelany@theocc.com. You can get in touch with the OIC Investor Services desk at that email address. You can, you know, follow us on Facebook and Twitter, join the conversation, whatever. It's the usual old stuff, but I think it's interesting. We're always interested to have a dialogue with users and potential users. That's me done. Thank you very much for your attention. I'd be happy to take any questions. I think perhaps some of you come in during the...
We do indeed, yes. Thank you very much, Gary. That's been very, very interesting, and I'm hoping that our audience found that as informative as I did. A few questions here, which I'll put to you.
Oh, yeah.
I'm hoping they aren't too taxing, and you'll be able to answer them relatively easily.
I'll do my best.
Fantastic. Firstly, so the first question you have here is, I've never traded options before, but I'm keen to get started. Is there a certain strategy you think is suitable for a beginner? Well, remember when you're trading an option that you probably have to have a view. You've probably got a view on what stocks are going up or going down.
I think from the point of view of starting your trading career, I would say keep it simple. I would say certainly work from the long side, buy a call or buy a put. You can make a strategy cheaper by trading something which is out of the money, but if you do that, of course, the market's got to move more to make money. So I think in brief terms, I would trade a stock that you're familiar with, or an option on a stock that you're familiar with. I would trade, from the long side. I would buy a put or buy a call. Yeah.
Fantastic. Thanks so much. The second question does follow on a little bit there from a part of your answer there, where we've been asked, sometimes it can be hard to choose the strike price and the maturity. Can you give us any guidance on that?
Well, I think it's important to remember that time decay steepens the further along you go. But having said that, sometimes option strategies fail because people aren't buying enough time. So I did mention that weekly options were popular, but that is for traders and investors that have a very specific view. I think I would be looking to trade something, at the money. You could say trade something at the money or slightly out of the money, so the market hasn't got to go too far in your favor for the position to become profitable. And also, to buy it, a little bit further out, so that you've got time for your strategy to work. I think those would be my principal considerations.
Fantastic. And actually, surprisingly, the last question actually again follows on from what you just said.
Yes.
Actually.
Yes.
And the question is, are there any good ways to reduce the time decay effect when trading options? Are there any particular strategies, perhaps, or is this a question more for the advanced session we'll have?
I can see that coming into the advanced one. Well, I suppose, buy perhaps a little bit longer than you think you need if you're worried about time decay. But again, it depends what you're trying to do. You might want to capture the time decay, in which case time decay is your friend. Whereas if you're holding an option, time decay is your enemy, and you should position yourself accordingly.
Fantastic. Thank you so much.
All right.
That's the only questions we have for you today, but I'm hoping we'll have a few more questions for you when we meet you again in a couple of weeks' time. So I'd just like to say once again a huge thank you. I think it's been fantastic, and I'm hoping the audience have taken a lot from everything that you've got to say, and that we'll start seeing some new faces trading the options on our markets in the Nordics. So it just remains for me to say thank you so much again. We will hope to see you all in 2 weeks' time, and thanks very much for listening.
Yes, thank you, Richard. Thank you again for hosting this and inviting me, and look forward to speaking to you all again soon. Thank you. Goodbye.